Most income investors want the same thing: enough cash flow to cover their bills, a dividend that keeps up with inflation, and a portfolio that does not blow up on them when the economy gets rough. Simple goals. But finding stocks that actually deliver all three at the same time is harder than it sounds. Because here is the problem with high-yield stocks. When a stock yields 5% or more, there is almost always a catch. Maybe the debt load is too heavy. Maybe the dividend is barely covered by earnings. Maybe the business has no growth, and the yield is just artificially inflated because the stock has been quietly falling for 2 years. I ran a screen looking for stocks that yield at least 5%, but only those with 10 years growth, an investment grade rating, and a high safety score. Very few stocks made the list. In this video, I am going to walk you through the 4 most interesting ones. The first stock is Prudential Financial, ticker PRU. Dividend yield of 5.4%, a safe dividend safety score, an S&P credit rating of A, strong investment grade, and a 3.7% dividend increase announced earlier this year. Prudential has been in business since 1875. It is one of the largest providers of life insurance in the world, with roughly $1.5 trillion in assets under management across insurance, annuities, and retirement solutions. This is not a small or fragile business. It has navigated more than a century of economic cycles. The dividend track record reflects that durability. Prudential has raised its dividend for 17 consecutive years. That crisis taught the company painful lessons. Today, the business is more diversified and safer. There is one specific issue weighing on earnings right now. Prudential's Japan business is currently under pressure. This is due to employee misconduct affecting client damages. New sales in Japan have been suspended through November. However, around 90% of the Japan unit's profits come from existing policyholders, not new sales. The payout ratio sits around 40% of expected earnings, well covered. The valuation is currently near the low end of the 5-year average PE range, which historically has been a reasonable entry point. For income investors who want a durable business with a 5.4% yield, Prudential checks most of the boxes. The second stock is Paychex, ticker PAYX. This offers a rare combination of high income and high growth. Yield just over 5%. Dividend raised by 10%. A safe dividend safety score. BBB+ credit rating. And a 15-year streak of consecutive dividend increases backed by over 3 decades of uninterrupted payments. Paychex provides payroll processing and HR software to small and mid-sized businesses. These are essential services. Switching payroll providers is a significant operational disruption. That stickiness shows up in the financials. Earnings have nearly tripled over the past decade. Revenue has nearly doubled. Operating margins run around 40%. Now the honest risk, and this one matters. The market has punished Paychex severely. The stock is trading near a 52-week low. The forward PE has collapsed from a 5-year average of around 27 to just 16 times earnings today. The reason is AI. The market fears AI tools could allow small businesses to run their own payroll. But payroll is genuinely complicated. Tax compliance and employment law carry real liability risks. Paychex is also actively integrating AI into its own platform. Clients can already run payroll via voice. This is a high-quality business going through a fear-driven reset, creating a meaningful entry opportunity. The third stock is NNN REIT, ticker NNN. Dividend yield of 5.4%. A 3% raise last July, with a similar raise expected this summer. A dividend safety score of 80, firmly in the safe category. BBB+ credit rating. NNN REIT is a net lease company with around 3,700 freestanding properties leased to 400 tenants. The portfolio is genuinely diversified. Automotive services, convenience stores, and restaurants are the biggest sectors. These are deliberately chosen for their resistance to e-commerce disruption. You cannot get your car serviced through Amazon. The lease structure is key. Triple net leases mean the tenant pays insurance, maintenance, and taxes. Triple net leases mean the tenant pays property insurance, maintenance, and taxes on top of rent, leaving NNN with extremely high margins and highly predictable cash flows. Average remaining lease terms run about 10 years. The payout ratio on adjusted funds from operations has held very close to 70% for the past decade. And the dividend track record here is exceptional. NNN REIT has increased its payout for nearly 40 consecutive years, averaging consistent 3% annual growth over both the 5- and 10-year periods. With the current payout ratio near the low end of its range, there is room for continued raises. Analysts expect around 4% cash flow growth in the year ahead, which comfortably supports the upcoming dividend increase. Think of NNN as a defensive, near-bond-like holding that consistently outperforms fixed income. You get steady income with annual growth that protects your purchasing power. That has genuine value. The fourth stock is Enterprise Products Partners, ticker EPD. Dividend yield of 5.6%. An A- credit rating, the highest of any midstream company. A safe dividend score and 3% growth. Note, EPD is an MLP, which means it issues a K1 form at tax time rather than a standard 1099. EPD is one of the largest energy infrastructure companies in the U.S., with over 50,000 miles of pipelines. The business model is resilient. EPD earns fixed fees every time energy moves through its infrastructure. Most business is protected by long-term contracts with inflation escalators. Cash flow kept rising during oil price drops. The payout ratio has held a little below 60%, one of the healthiest coverage ratios in the midstream sector. Debt levels have actually come down significantly over the past decade, supporting that A- credit rating. The payout ratio has held a little below 60%, one of the healthiest coverage ratios in the midstream sector. Debt levels have actually come down significantly over the past decade, supporting that A- credit rating. And the distribution has grown for 27 consecutive years, averaging around 3 to 4% annually. However, and this is the honest caveat, valuation is not attractive right now. Prices are elevated. The Middle East conflict created a global shortage in natural gas liquids. Buyers are scrambling for supply. The yield is currently 5.6% versus the 7.3% average. You are paying a premium today. If you own it, hold. But starting a new position means buying the tailwind at full price. Wait for better value. 4 stocks, 4 different situations. 1 unifying lesson. Finding safe high-yield stocks is hard. The 4 stocks we covered today cleared a demanding set of filters. All yield above 5% and are safe. Prudential is the long-established insurer with a temporary Japan headwind, creating a reasonable entry point. Paychex is the recurring revenue compounder the market is pricing for AI disruption that is not a certainty. NNNREIT is the 40-year defensive holding that delivers steady inflation-beating income without worry. Enterprise Products Partners is the gold standard of energy income, but rewards waiting for a better price. A high yield is the beginning of the research, not the end of it. The question that matters is not what the yield is. The question that matters is whether the business behind it can sustain and grow that payment for the next 5, 10, and 20 years. That is the work that separates investors who build lasting wealth from those who chase yield and lose. Do the work, build the portfolio, and let the compounding take care of the rest. Build something that lasts. If this breakdown gave you a clearer picture of any of these 4 names or a better framework for evaluating high-yield stocks, hit subscribe. More analysis like this every single week. Let us build something that lasts.